The financial markets are throwing a collective tantrum right now, and if you feel like you are watching a slow-motion car crash, you are not alone. The Nasdaq Composite just logged a brutal 5-day losing streak, dragged down primarily by a massive sell-off in semiconductor and tech stocks. For months, the mainstream narrative was that the tech sector was an unstoppable money-printing machine, but the tide is turning fast. When the foundational chips that power the modern digital economy start taking a nose-cone dive, it sends a shiver down the spine of the entire financial ecosystem. This isn't just a minor blip or a healthy breathing room for the market. It is a fundamental shift in how investors are looking at risk, and it is exposing just how fragile this entire economic expansion really is. To understand how deep the rot goes, you only have to look at Oracle, which just suffered its worst weekly performance since the absolute depths of the dot-com bust back in 2001. The stock plummeted nearly 20% in a flash because the underlying math simply stopped making sense to Wall Street. Oracle is sitting on a mountain of debt totaling over $130 billion, while simultaneously bleeding out $24 billion in negative free cash flow. At the exact same time, their capital expenditure has skyrocketed by over 160%. In plain English, they are spending astronomical amounts of money they do not have to build out infrastructure, burning through cash at a terrifying rate, and piling on debt to fund an AI dream that is yet to yield a single cent of actual profit. When a legacy tech giant starts exhibiting the exact same financial behavior as a bankrupt pre-revenue startup from the late 90s, the alarm bell should be ringing at maximum volume. While Oracle is a classic example of corporate overreach, the drama surrounding SpaceX shows how this speculative disease has infected the credit markets. SpaceX recently issued billions of dollars in new debt right after a massive internal valuation shuffle, and bond traders were instantly caught completely flat-footed. Losses on these new SpaceX bonds are already mounting past the $300 million mark because the deal was flooded with fast money accounts looking for a quick flip rather than institutional investors looking to hold long-term. This created a technical nightmare where a deluge of supply met a sudden vacuum of demand. Even stranger, the underlying stock valuation has been swinging wildly, losing hundreds of billions in paper value practically overnight. The fact that Moody's granted this massive cash-burning machine a stable credit rating raised eyebrows. But the real kicker is that institutional players are now actively trading credit default swaps against SpaceX debt. When Wall Street starts buying insurance policies against your company defaulting on its bonds, it means the big boys are quietly placing massive, leveraged bets on your ultimate downfall while the public is still being told to buy into the hype. This entire mess exposes what is being called Wall Street's $270 billion AI speculation machine. We are currently living through what is, by almost any metric, the most expensive and overvalued stock market in American history. When things get this detached from reality, the ultimate reckoning is rarely a gentle landing. Historical data suggests that when a market stretches this far above its long-term historical trendline, the eventual reversion to the mean is catastrophic. Some of the most seasoned bears on the street are calling for a 70 to 80% decline in the Nasdaq just to get back to historical norms. While the exact timing of a crash is impossible to pinpoint, whether it takes 2 weeks, 2 months, or 2 years, the structural imbalances are so severe that a massive wealth destruction event feels practically baked into the cake at this point. You can see the cracks widening when you look at the absolute royalty of the tech world, as every single megacap stock has officially entered a correction, and some are in a certified bear market. Tech behemoths like Microsoft and Meta are down roughly 30% from their recent all-time highs. This is a massive psychological blow to everyday investors who treated these stocks like high-yield savings accounts that could never go down. The fundamental question the market is forcing everyone to answer right now is whether these tech titans are actually hyper-growth engines of the future, or if they have simply transitioned into regular old, slow-moving companies saddled with unimaginable capital expenditure burdens. The profit margins are being eaten alive by the sheer cost of building data centers and buying advanced chips, and the return on investment is nowhere to be found. The reality is that the metaphorical juice has been completely squeezed out of the orange, and investors are left holding a handful of expensive pulp. The leadership at these companies seems to be panicking behind the scenes, pivoting their strategies on what feels like a daily basis because their expensive new toys are not working. Take Microsoft's Copilot for example, which has been plagued by user complaints that it simply is not useful. Microsoft has been awkwardly shuffling the underlying artificial intelligence models powering the service, jumping from OpenAI to Anthropic and now eyeing external open source models. This constant flip-flopping proves that there is absolutely no economic moat in this business. If a company can swap out its core technology with a click of a button, then the technology itself is a commodity, not a proprietary goldmine. Meta is doing the exact same thing, burning billions of dollars to develop open-source large language models that nobody in the consumer market actually asked for. Instead of focusing on their core, highly profitable advertising machines like Facebook, Instagram, and WhatsApp, they are chasing a shiny object that is actively destroying shareholder value. This entire phenomenon of buying things purely based on faith rather than cash flow ties directly into the broader critique of the digital asset space, specifically cryptocurrency and Bitcoin. Critics have long argued that assets that pay no dividend, represent no physical property, and generate no economic output are inherently unstable speculative pyramids. The entire valuation is based on the hope that someone else will come along and buy it from you at a higher price down the road. While proponents argue that the massive energy expenditure required for proof of work gives it intrinsic value, skeptics rightly point out that proof of unnecessary work shouldn't be worth anything when the economic tide goes out. The most important thing to remember is that the modern crypto ecosystem has only ever existed during the longest, most aggressive macroeconomic bull market in human history. It has never been tested by a prolonged, brutal economic winter where global liquidity completely dries up, and when that day comes, faith-based assets are usually the first to be wiped out. If you study financial history, none of this is actually new. We are just watching the latest chapter in a book that has been written 100 times before. Every single grand technological breakthrough in human history, from the railroads in the 19th century to the internet at the turn of the millennium, has been accompanied by a massive wave of irrational overinvestment and a subsequent total financial collapse. The railroads genuinely changed the world, but almost every early investor lost their shirt building them. The internet completely revolutionized human civilization, but during the dot-com crash, foundational companies like Amazon plummeted over 90% before they eventually rose from the ashes to inherit the earth. AI is clearly a dazzlingly powerful concept, but because everyone knows it, everyone poured their money into the exact same trade at the exact same time, guaranteeing an absolute bloodbath of overcapacity. We are still firmly trapped in this peak bubble mentality, epitomized by charismatic figures promising space-based data centers while simultaneously trying to transform their electric car companies into your phone provider and your bank. It is the ultimate sign of a market peak when a single entity tries to control everything using borrowed money, and history tells us exactly how this movie ends.